Hello everybody, thanks very much for joining the first in our new series of webinars. I'm Mandy Merrin and I'll be chairing this morning's session. I'm joined by my fellow partners, Tim Stovold, who's Head of Tax, Richard Cummings, who's the Managing Director of our HR consultancy, and the main speaker today, who's Dan Leaman, who's a fellow Director in Corporate Finance with me. He specialises in working with clients on how to adapt and plan for the future. He's had 10 years experience with us, giving clients strategic advice, and 8 years experience in industry as both CFO and COO, where he worked on the floor, as it were, through some of the issues that he's going to talk about today, which we think brings a unique perspective. Thank you very much indeed for those of you who completed the poll in advance. We will be sending out a poll afterwards, and as ever, it will be super if you could just spend 2 minutes completing this so that we know how we've done and what we can do better and other topics you might like to hear about. There is a Q&A function at the bottom of the screen in which you can post questions as we run through. Where we can, we'll answer them as we go in the chat, in the question and answer bit, but there will be time for questions at the end of the webinar. So I think that's it from me, and I'll hand over to Dan. Dan, take it away.
Hi everyone. Thanks, Mandy. Yeah, as Mandy said, I've got both hands-on experience and advisory experience of dealing with downturns and managing businesses through to recovery. And I'm going to talk to you today about the way I approach a downturn, the steps I take, and the kind of things I consider. Tim and Richard will interject a bit later to talk through specific tax and HR issues. And I want to start today, though, by looking at some of the answers we had to our poll. So, if I can share my screen successfully. Then I'll go straight in there. So, the first question we asked you was about the last 6 months of trading and the impact of the pandemic compared to last year's trading. And as you'll see, 67% of respondents have reported decreases in revenue, and of those, 60% say significantly down and by over 15%. However, 11% of people have reported increases in revenue, which is a nice thing to see. Interestingly, when we're looking forward, the situation is similar, but slightly more positive, which is a good thing, I think. So we've got 18% seeing increases in revenue for the next 6 months compared to last year, which is higher than the last 6 months. And the decreases are 64%, and only 51% of people are seeing it significantly down. However, I think everyone will see that 51% saying it's significantly down shows that there are still going to be rocky times ahead. So it's perhaps an apt topic we're covering today. When I start an assignment like looking at a stress situation and thinking about how a business can recover, I really have 6 objectives. And they're to identify a sustainable business model, ensure that the business has sufficient liquidity, try and create a scalable platform to recovery, and key in that is also protecting long-term business value drivers, address uncertainty, which is something we're all facing at the moment, by planning for different scenarios, give clarity. One of the biggest questions that we're asked is, have we done enough? And if we haven't, what is plan B? So I think it's really important to cover those and to think about going forward from doing your planning to monitor or outturn against any plans, and then go into a process where you refine assumptions and adapt as required. So the process I go through is something like this, where we start with situation analysis, we go through modelling, we do action planning, and then we go into monitoring. And I think that works when I've done it before. Digging down and sort of unpacking these one by one, situation analysis, what I look at here, obviously I start off by looking at sort of current trading levels, cash flow and solvency. And it was really interesting looking at the poll that we did, that something like, if I can find my notes, 47% of people who responded said that they had over 6 months overheads in cash, which is a really, really strong position and really nice to see. However, 20% of respondents said they had less than 3 months overhead in cash. And what I'd suggest is, the thing about trying to turn around and restructure a business is it doesn't happen overnight. So for businesses with less than 3 months in cash, there's a bit of impetus if they do think that something needs to be done, that you start earlier rather than later, because that cash can dwindle quickly, and often restructuring has certain costs which will drain cash as well. So looking at where you are is key. Looking at your pipeline is fundamental. Income is king when it comes down to it, and knowing where you're going to be and where you think you're going to be is really key to your planning. Interventions already taken. It was really interesting looking at your responses to that question. Something like 90% of people who responded said that they've implemented home working for some or all of the time. Nearly 70% of respondents have used the furlough scheme. 25% of respondents had taken out either a bounce back or receivables loan. So access to finance has been taken up by quite a number of people. 52% of people have already done some redundancies, and that's split roughly 26% of more than 10% of headcount and 26% less than 10% of headcount. And then on top of that, people have also negotiated pay cuts with staff, which was 36% of respondents, and negotiated short-time working with staff, which was 24% of respondents. So it's very clear that a lot of interventions have already been done, and the big question is, are they enough? And how do we look at those when we're thinking about the future? So that's what I'm going to focus on. It's worth pointing out there are other things to look at your current situation. I always start by looking at people's asset bases. One of my restructuring projects in the last recession, which is going back a while, was a business that was really, really short of cash. However, it had significant stock levels, and by actually liquidating some of that stock, even though it was at a loss, generated sufficient cash to generate breathing room to allow for the project to then be taken through to completion, and the business to, in that case, find a new home without being put into insolvency. So looking at your asset base and understanding it, looking at your liability base is also key, because there will be opportunities potentially to talk to people you owe money to and get their support. Current people structures and capacity. Capacity is key here. Understanding what your people can do, who you have, and how much work they can facilitate means that you can start to think about matching that to your pipeline and your future income, and actually understand how many is the right number of people you need. Impact assessments for your customers and suppliers are fundamental. All your customers and suppliers could be, depending on your sectors that you service, impacted differently, and understanding where the ones are that are impacted more and less is fundamental. And current structures, current tax structures and premises is important to look at as well. Modelling is the next stage I go to. And when I'm talking about modelling, I'll be clear what I'm talking about. I'm talking about an integrated financial model that looks at profit and loss accounts, cash flows and balance sheets, driven by assumptions, and that covers sort of the next 18 to 24 months. That's really key, because part of the process, as I mentioned at the beginning, is to identify a sustainable business model and work towards it. But as you'll see, the next part is to understand whether you've got liquidity to see you through to that model. And it's only by looking at a fully integrated model that you can really get a feel for that. So what you should end up with is a realistic base case that identifies how much cash you've got and where it can be used, so that you can review trade-offs between cash conservation and investment for the future, which is always one of the more difficult things in these situations. It's not right to stop all investment for the future, because otherwise your recovery will be impacted. But equally, you have a duty to conserve cash, and then juggling those two, using a model to help you go through that process is really helpful. The other thing about a model is you can then do easy scenario planning from it, and you look at different scenarios which will allow you to look at upsides and downsides. And most importantly, the model will quantify the size and duration of any liquidity and profitability gaps that need to be filled. And if it does show gaps, then we need to take action. So where I start when I'm doing action planning with my colleagues, and this is not a one-man action plan, and this is we generally dial in experts from across our firm, HR, tax, legal, forensics, as required. And so we try and look at all different things. But where I really start is questioning old truths, because I think it's really important that you don't take things for granted, and we don't start with a set of fixed assumptions. So I'd say everything is on the page to start with, and we can question any of those matters. The next thing I'd say, again, is that stakeholder engagement is key. If we bring landlords and funders and our employees with us on this journey, and maybe even customers and suppliers if appropriate, we're much more likely to get them to buy into any action plan and support the business as we go through, rather than if we hide from them. So the right communication with stakeholders needs to be built into any action planning. Cost-based right sizing, and the reason I have it here rather than earlier is that I believe the best time to be making the decisions about what is the right size is once your model's done and you actually can see the gap you've got to fill. Outsourcing versus in-housing. So it is very appealing to outsource non-value adding services and turn them into a variable cost rather than a fixed cost. However, you've got to be aware that there can be cultural and flexibility and agility issues that come with that. So balancing them off against each other when doing your planning is really important. I've mentioned matching resources to requirements. Changes to taxation structure. Tim's going to talk to you in a bit how you can actually generate cash through tax. People often think it's the other way around, that tax takes away your cash, but Tim's going to tell us how it can work for us. Negotiating with landlords, funders, customers and suppliers. I find it really interesting when looking at your responses that something like 28% of you had managed to either get a rent holiday or secure reduced rent or rent deferments from landlords. So landlords are being supportive at times, and a lot of them would rather have a tenant in the future than no tenant at the current time. So there's options there. Fundraising requirements and restructuring options are also to be considered. And then monitoring, what I'm talking about here is actually looking, once we've done the model, at how we're doing against it. Trading and cash flow against forecast is key, and it was very interesting to see that 97% of you are doing monthly management accounts, so you have the ability to do that. 13-week cash flow to manage short-term working capital is really important, and 67% of you have got rolling 13-week cash flows, which is really good, and pipeline monitoring to check that the income assumptions we have in the model stand up. But you've also got to think about macro developments like Brexit and when to reforecast if required. It's also worth saying monitoring is not just about trading, but it's also about the implementation of any action plans, because having the plan isn't enough. We've actually got to get it done and get it done as promptly and quickly as we can. And any changes to the action plan that are required. So where I end up is with a more cyclical process, something like that, where we end up ideally going through cycles of planning, where as more information comes through, we then start the cycle again and refine our plans. And that, in my view, every 3 to 6 months, that is a cycle that is well worth going through at the moment. So I'm going to talk quickly about some key considerations, and I don't have time to cover them all, but I'm going to go through the ones in bold. So the commercial and operational ones I want to talk to you about are obviously looking for diversification and new sources of income, thinking about what your clients want and need, what other budgets that are within your clients or customers that you could access if you're dealing B2B, and which sectors are doing well and where you can target new business is really important. And any new service lines. Customer impact assessments will help you with that. But one thing to be thinking about also when thinking about your customers is the default and credit risk. Going into a recession, the risk of someone defaulting on what they owe you is significantly higher. And so keeping a much tougher line on that and really monitoring it, and maybe even adjusting your terms to reduce your risk of that and exposure, are going to be really important. And don't just think about customers. Suppliers can also default if they hit trouble, and that can cause you problems with your customers. So thinking about the default risk on your suppliers as well, and whether you've got alternatives to that, I'd say is fundamental at the moment. Pipeline. So I'm going to talk to you about optimism and pessimism here. When forecasting and having sat around a board table and listened to my account managers reporting to me how they think they're going, I've often found that when things are going really well, the optimism around that table is really high and we're going to win everything that we pitch for. And equally, when things are going badly, the pessimism around that table is really high and we're going to lose everything we go for and there's never going to be any new business. So understanding that those human emotions affect people's forecasting and trying to see through it is really key, because starting with an overly pessimistic view of income can mean that you end up doing things that aren't right for the business and sacrifice the greater investment and value drivers because you're taking too pessimistic view of income. Now, I know things are tough, but trying to really cut through and get an accurate, reasonable forecast is really fundamental to your planning. And if you are going to have a pessimistic side, and using scenario planning to look at a downside scenario is where that needs to be for a plan B rather than in your base case. Accounting process and reporting also come into their own at the moment. It's really important if you're going to monitor that you have the information you need in a timely and accurate fashion. So making sure that your accounting function can give you that will really help you see your way through this journey. Financial considerations that I'm going to cover here. So we've got our asset base that I've already spoken about, but deferred liabilities. It's really important that people recognize that if they have deferred VAT and PAYE, the 24% of you have taken out loans under C bills or B bills, that people who've deferred personal tax payments and maybe have reduced their personal drawings out of businesses accordingly, but that people who have stretched creditors and delayed paying landlords, all these things are going to need paying back, and a lot of businesses have built up big liabilities. So even though quite a lot of you had over 6 months of cash in your bank account, so if that's been generated through deferring liabilities, the situation might not be as rosy as possible. And actually having a model that takes those payments into consideration and shows you the real position once those are normalized is going to be really key to understanding your working capital once we get through, say, the end of March next year, once all that has unwound probably. Working capital is the next thing I'm going to talk about here, because one of the things we see many times in recessions is more businesses actually really struggling as the recovery kicks in than as the downturn kicks in. And the reason for that is they use their working capital during the downturn to support them. And then when the recovery kicks in and the requirements of working capital grow, they don't have the cash reserves left to fund that. So through modeling, we can really see whether you can fund your way through to recovery, or if other things need to be changed within your business model to generate sufficient cash to fund that, as well as the actual losses that you may be making in a downturn situation. And then investment versus spending. Again, through the modeling, we can really look and dig into what are the decisions that are right for your business in that trade-off. Richard, I'm going to let you talk about people now because you're the expert here, so take it away.
Thanks very much. There's whilst this does look like a list, it's not actually a list. It's just a whole load of things that interlink with each other. And as Dan said, human emotions play a big part in this, and the job security for employees is right at the top of the list at the moment. So whenever you make decisions about people, it's always advisable to consider how that's going to affect not just the people that you may be losing, but the people that you may want to retain in the future. People are your biggest cost, but they're also your biggest resource. And there's a couple of things that I say when you look at structures. Obviously, over the last 6 months, there's going to be some parts of the business that are no longer required. And there are an awful lot of companies that are doing quite well at the moment, and that they're picking up income streams that they didn't have before necessarily, or they're certainly seeing more increased growth in those areas. So they're going to need more expertise in other parts of the business that they didn't have before. So when you look at the structure, my advice is to think further into the future. And if you are going to do some redundancies, it's always advisable do it once. So that if you're going to do it hard, I think, because the worst thing you can do is do one round of redundancies and then you settle everybody who's left, and then you do another round in 6 months and then you unsettle everybody again. So my next statement's going to contradict that slightly, because redundancy is an expensive business, and you need to think really hard about where your cost negative point is. So there's a point where this redundancy is going to cost you X amount of money. At what point are you going to get that money back? And you look at your salary bill and your cost savings over a period of time, and it's going to take you 6 or 7 months before you recover the money that you spent on the redundancies. Then maybe you might not want to do your redundancies if you think you're going to trade out of it in that time. Again, what Dan said about capacity is actually quite poignant. That really you need to look at the capacity within the team and see whether people can pick things up that they didn't necessarily pick up before. What we have seen over the last 6 months is that people have been very open and very willing to work with their companies. And if you communicate with them and you're very honest, they're more likely to do things like take pay cuts, take unpaid leave, defer salaries, defer bonuses. We've seen quite a lot of as well. And things like employee engagement can be maintained throughout this, and it is a difficult time, and it's going to have an impact on people's performance, and it's going to have an impact on their health, both mentally and physically. So I think the key to this is to get your people engaged into what you're doing, tell them what you're planning, and then do it. And so things like your restructures, any redundancies that you're planning to do, I know a number of people have already done them. If you're planning on doing more, I would look at the structure, not just now, but as Dan said, look at well into the future as well to see what it is you're looking for. There are things like pulse surveys, and which you can do. They're obviously, generally, when you do staff surveys, they can be quite bleak at this time, but I think it's quite important to talk to your staff and see what their key considerations are and what their worries are, and try and react to those. Now, they are a fantastic resource, and if you look after your people well, they'll look after you. So I think they're key to trading out of this. Tim.
That sounds like it's me. So Dan, can you just flip the slide on one? Right, Dan set me up to tell me I'm going to get all of your taxes back. Well, we're doing a lot of these conversations at the moment just to make sure that all of the sensible things have been done that are going to either refund tax already paid or have tax reliefs paid to by the revenue. So the place we start, only because I'm surprised on a daily basis how many businesses have high degrees of innovation in them and know nothing about the research and development tax relief system. If you think there's anything innovative in your business at all, or even if you don't, drop me a line. I will tee up a call with our R&D team, and they will spend 15 minutes just kicking the tires. Recent cases of that, I met a construction business, very high-end construction business, admittedly a week or so ago. They'd heard about R&D relief but hadn't really committed any management time to exploring it, and I listed a couple of the companies in their peer group that we know, and my gut feel is there's something between 500 and 800,000 pounds due back to them. Now, not committing management time to that sort of refund, and that's not a CBILS loan, that's not a temporary loan that has to be repaid, that's a permanent payment from the government towards the business for doing what it was going to do anyway. So R&D, if you haven't explored it, if you've put it on the to-do list, that should be a bigger priority. If you've bought a building, if you've fitted out a building, if you're about to fit out a building, depending on the energy that went into the capital allowances, so the tax relief that can be claimed for the items of plant and equipment in the building, that might need another look at, because those claims may not have been maximised at the time. It's always worth a second pair of eyes. So big amounts of property expenditure, worthwhile having another look at. Income extraction, I come across companies time and time again where the owner managers are taking everything out as salary. The least tax efficient thing to do, definitely look at the salary and dividend mix. It's going to change the timing of when the tax is payable, and by paying dividends you're not paying employers national insurance, at least for now. Pension contributions also ought to be looked at, whether you increase them or decrease them, but if that hasn't been looked at for a while, there's some easy wins there. If you've racked up some losses, let's accelerate the period in which you can claim them. So although we have to be careful, a lot of these ideas come with a word of caution. A change of year end, so bringing your accounting period to an end earlier than you might otherwise do, could allow you to use your losses sooner. If you paid tax last year but you've got losses to date, let's find a way of carrying those losses back and getting a refund of that tax. Don't just sit and plod along, wait for your accountants to get in touch at the end of the year, wait another few months to actually find what your losses are worth to you. That's something you can accelerate, and that is your choice. Time to pay arrangements, Dan mentioned those just briefly. VAT is the one that everyone's focused on. Come 31st of March next year, you're going to have an extra quarter's VAT to pay if you deferred it back earlier this year. That time to pay hotline is going to be smoke pouring out of the machine that allocates those calls, because everybody is going to be calling up and trying to kick that payment down the track, trying to agree to have the catch-up payment spread over 3 months, 6 months, 12 months, whatever you can agree with the revenue. Get in early. I think now is probably too early, but certainly towards the end of the year and into the very beginning of next year, get in early, give the revenue an update on your trading performance, try and agree deferred payment terms for bringing your taxes up to date. Pension and salary sacrifice, another one I continually am surprised by. I've got one of my employment taxes team working pretty much full time on this at the moment for our clients of having a real push around pension salary sacrifice. At the moment, if you're on the default contribution levels, employees are putting in 5% of their own money. If that's moved to a salary sacrifice, so they take a cut in their salary and the employer puts the money in instead, they're completely neutral, as is their pension, but there's an employer's national insurance saving. Even for relatively small businesses, that is £10,000–20,000 a year for little effort up front. Normally employers agree to put that national insurance saving into the pension, but a full and frank discussion with the employees could be, look guys, girls, help us out here. We're going to take the national insurance saving now just to keep the business solvent, and in a year or two's time, when normality resumes, we'll help you top your pensions up. But this is something employees can agree to do to really help the business. Group structure simplification. We continue to meet businesses every time the owner manager has a new idea. They form a new subsidiary, they incur an extra cost of accounts and corporation tax returns. Now's the time to look at whether the group structure is fit for purpose. If we can chop some companies out, that's going to reduce down compliance costs. Mostly that can be done in a tax neutral way. Share options. I've got one client, a tech client, where they agreed with their employees that they would take pretty drastic salary cuts over the tough time, and they're now putting in place a share option scheme on a very low valuation, because we've managed to convince the revenue that the company's lost most of its value over this time, which is not probably what's going to happen in the longer run. And the employees who've agreed to take salary cuts are all getting relatively small amounts of share options each, but on the basis that they earn back everything that they've given up in the future if the company performance improves. Now is the time to agree low values with the revenue. They're being pretty decent about agreeing low values, accepting what effect COVID's had on things. And then the last thing in tax, we love an acronym, EOTs, Employee Ownership Trust. This is the new ownership structure that's been around for a couple of years now. This is where you can sort of re-enfranchise the employee base. They'll have indirect ownership of at least half the company, but there's a big tax advantage for owner managers putting this in place, in that they get to sell at least half the company. Most are selling all the company to one of these trusts, and it's a completely tax exempt disposal, and then they're paid off over time as the company continues to make profits. If I were selling this just on the tax advantages, I'd say it's tax-free dividends for the next few years, but it can be used in a wider strategy as a sort of indirect management buyout. So happy to talk more about those if anybody's interested. Do follow up with me through the Q&A or directly if you want to hear more about any of those things. Back to Dan.
Thank you, Tim, and thank you, Richard. Really helpful. So where I'm going to go to now is talking about, if we've looked at all those things and our model's still showing a cash flow gap, what then? We've looked at all the cost-cutting options, we've looked at all the restructuring options internally, we've looked at tax, we've looked at people, and we still need more cash to keep going. Then we've got to look at further, more drastic actions, really. Now, it can be as simple as a debt fundraising. There are businesses out there that are not highly geared. Maybe if you've got factorable debtors and you've got no invoice discounting in your business, you can easily access and make additional working capital through that kind of process, potentially. Maybe we've got to look at equity fundraising. That's something I'd always consider, especially if your current shareholder base are supportive and are willing to maybe give the business a bit of help through a dark time, hoping for some payback in the future. I've also got acquisitions on here because I don't want to be too doom and gloom. Different businesses will recover at different paces, but the ones that do recover quickly and early might have the opportunity to sort of take advantage and make some good acquisitions, helping other businesses out of a spot of bother and giving them a new home. So acquisitions might be a very good way of both improving your business and helping another business out. So a great opportunity now to look at that, especially if you are cash rich. Accelerated M&A is something I'm going to talk about if all else does fail, and the sort of flip side of the acquisitions coin is the disposals coin. And it may be that the right thing to do is just to try and quickly find the business a new home if you are concerned that there is no way out of your situation. But equally, non-cash consolidation can be something that we look at. Can be really interesting. We can find businesses without critical mass, put them together, and end up with businesses which do have a critical mass when they are part of a single group, because overheads, etc., are all shared. So there are options even when things look bleak. And if things look really bleak, then there are still other options. And I'm not going to go through all the type of formal insolvency procedures. I'm just going to really talk about the first one, and that if there is a concern that your business is not a going concern or may not be a going concern in the future, I'd encourage everyone just to talk to an insolvency practitioner early, because it protects your position and probably gives you more ability to create options. But most importantly, it's got to be very key to avoid wrongful trading. I know there's been talk that wrongful trading has been suspended, but directors still do have a duty of care, and it's important to make sure you look after that. So coming to speak to a specialist there is really key. But also the specialist might be able to help create other options and help you restructure formally for the future as well. So there's still options even then. I'm going to finish off by going through a brief case study. So this is a project I think I did maybe about 5 weeks ago. Realtime example. It was a PR agency that approached us, and they were in considerable distress. To give you a feel for the scale of what had happened, their trading revenues had reduced by 66%. So they were doing roughly a third of what they were doing pre-COVID, which is a massive, massive fall. And therefore they were considering whether to take a receivables loan out, but they also thought it might not be appropriate because they might not be able to pay it back in the future. They also thought they were going to run out of cash within 6 months, and really they were worried that their only viable option was just to close the business down. So we worked with them and we did a lot of modelling and a lot of scenario planning to try and identify what a sustainable business model could be like for that significantly reduced income, what the right mix of skills they need, what the right staff mix, and actually they then spoke to a lot of their staff and actually managed to agree a number of people taking pay cuts, short time working, and unfortunately there also had to be some redundancies. However, by doing all of that and also really having a really good look at their cost base and really right sizing some of those expenses, we identified the sustainable business model. We then tried to see whether they had the cash to look at it, and based on their cash flow, it still showed they were going to run out of cash sort of by November, December. When we created a proper integrated financial model, starting with up-to-date balance sheet information that we encouraged them to produce, and really drilling into the assumptions and the working capital cycles, we discovered that actually their sort of non-integrated cash flow was actually full of errors, and that the cash position was significantly different to what they had understood it to be. In fact, we discovered that if they had enough cash to do the restructuring that we suggested, and also trade all the way through to the end of next year, even in their downside scenario. So that gave them significant confidence then to go through and implement the plan and restructure, and hopefully, they can then go on to rebuild from there. And it's really, and they also really appreciated Richard's team helping them actually implement those redundancies when they implemented them. So all in all, it was a really successful project. The business is now smaller, but really fit to see through the recession and get through to the other side and recover. So really happy. And the directors' feedback was that we'd given them a really good understanding of where they were and a really good process to go through to make their decisions, and confidence that their decisions were the correct ones for the business and for the people who ultimately they managed to save most of. So good job. And that is where I'm going to stop today and hand back over to Mandy. And I'll stop sharing my screen hopefully as well.
Dan, thank you very much indeed. And Richard and Tim, I think that gives everybody a bit of food for thought around the thought process and the planning that needs to go in looking forward, and the rigor seems to me that you need to address it with. We've had a couple of questions in advance and one question raised in the session so far. Please do post any questions you have in the Q&A. But the first question is very much directed, I think, at Richard. How do you recommend you introduce salary deferrals or cuts? They seem to be optional only, and employees and senior management can simply say no.
Well, actually, they can. So I think it was slightly easier at the start of this. The companies that went first and said we'd like everyone to take a 20% pay cut so we can stop, you don't have to make any redundancies, and you put a timeline on it, because people tend to agree to it if there's a timeline, and you say, we're going to do this until Christmas, and then we'll hopefully go back to normal in January. As we carry on, it seems like we're not getting out of this, and people starting to be a little less willing to do that. However, if you do say that we think we can prevent redundancies if everybody takes a 20% pay cut, and again put a date on it into the future, which now probably wouldn't be January, it'd be March or April, most people, certainly we've seen, have agreed to it. There's a couple of people that won't. The alternative to that is to go into formal consultation, and we just start consulting and do it that way. In an ideal world, you just position yourself where you're at, explain the situation, say the alternative, you paint two pictures effectively. We're going to have to make some redundancies, and it might be you, and you don't want to be made redundant because you're probably not going to get another job, or everyone can take a pay cut for a period of time, and then we can put everyone's salaries back again when we think we've traded out of this. Things like deferrals in terms of bonuses and stuff like that, that's a little easier. Most people can live with that if they think they're going to get it in the future. So if someone's due a bonus around about now, and you say, when it's not in a position to do it, we'd like to pay it in March, they're probably going to agree to it. Most people are going to agree to it, certainly in what we've seen over the last 6 months.
Richard, in your experience, because you've worked with clients on this very thing, do people generally go along with it and want to accept the idea that you might take a pay cut in order to save jobs?
Yeah, most people do, and nobody really wants to be on that list. And I guess most people think they might be on it, and in terms of that, they have. And we've had clients of up to 300 employees where they've explained the situation, and we've had unanimous, all 300 employees agreeing to take a pay cut, and because they don't want to see anybody get made redundant. Yeah,
I can see that. Okay, thank you. I've got a question now, which I'm pretty certain is directed at Tim. When would be the right time to get in touch with HMRC, read the deferred pay scheme?
Short answer is probably sooner rather than later. One thing you shouldn't be doing is leaving it, taking the VAT in particular, until the 31st of March to try and agree some sort of deferment terms. The revenue are very good at keeping notes. So if you're absolutely certain that you're not going to be able to pay your VAT off on the 31st of March, ring them now. Ring them now and say, look, I'm really worried. I'm really worried. I'm taking advice about closing my business down. Really looking at my cash flow. The only way I'm going to be able to clear that is in installments in 12 months or whatever you think is reasonable. They will say, I guarantee you, 90% certain, they'll say we simply can't agree anything now. It's too early. But they will put a note on the file. And the next person you speak to, which will be somebody completely different in their call center of 2,000 expert call handlers, will look at that note. And I think if you build up the story, maybe even if you ask for 18 months at the start, and as you ring back, you say, actually, things are starting to look a bit better. Can we now do it over 12? But start that dialogue. I doubt you're going to agree any deferment terms for anything that's due next year. But just putting in a call now, hopefully you'll get through quite quickly. I haven't had any feedback from clients for a while on getting through to the time to pay hotline, but hopefully you can get through reasonably quickly. But you really ought to be putting a lot of energy into this, probably from the 1st of January, if your payment is due on the 31st of March. If we're talking about VAT, you may have other deferments in play, but I would say with 3 months lead time, try and get something agreed. I would have thought the instruction from government to the revenue will be to continue to be sympathetic, but it's a little bit potluck depending on who you get when you ring the call centre.
Thank you, Tim. I'm going to turn to one of the questions we had in advance now, which is a question for Dan. Dan, this question is, what strategy can we use to help pivot our business if we find that the business is struggling in the current environment?
Yeah, I mean, lots of businesses are trying to pivot, and I think you've got to really start with customers. Customers have to be the centre of everything, always, for me. So what do your customers want? And what can you do for them have to be your first two questions. Obviously, there's considerations like channels. If physical premises are difficult to access, so you're not having the footfall, are there other channels you can look at? There are other things you can also look at. If you're a B2B business accessing one type of budget holders, asking that person for introductions to other budget holders within the organisation and trying to spread out across an organisation is often a really good strategy for growth. Likewise, if you can see some of your sectors are really doing well, because there are plenty of sectors that are actually doing okay at the moment. Gaming is a highlight. Healthcare is a highlight, clearly, for some sectors. But really understanding which of your clients are doing well and then trying to focus on new business for them is another way to pivot and really focus your efforts where you've got the best chance of getting a reward from them.
Great, thank you. Tim, a question for you. HMRC are not paying back VAT credit that was submitted. Will this be set against the VAT deferral, or can we push to get it back?
The rules of the VAT deferment was all refunds would continue to be paid. So absolutely, the revenue shouldn't be sitting on your VAT refund, as security for the payment that isn't even due until next year. There might be other reasons for them holding it up. They might be doing checks on it, but it's a war of attrition. Someone needs to jump on the phone and find out what the problem is. I don't know whether we're looking after that one for you, but if we're not, do let me know and I'll introduce you to one of my VAT team who'll be happy to give you a bit of guidance as to the approach you should take.
Okay, lovely. Thank you very much. There's another question in here about EOTs.
Yeah.
Let me just get my head around it. I've been considering options to reduce personal risk and thought about an MBO or a PE. We've had approaches, and EOT is an interesting thought. And actually, just speaking from a corporate finance point of view, we're seeing a lot more EOTs being used for this very purpose in terms of bringing employees in and having an investment in. I'm sure there are pros and cons. I got lots of questions, but a key one is, what is the impact on the day-to-day running of the company, decision-making, and so on and so forth?
The short answer is none. I mean, you would still remain director. You no longer be shareholder if you'd sold your entire interest to the EOT, but you can continue to be director, run the business, still be paid your full salary. When we put in place EOTs in order to get the biggest bang for your buck in terms of employee engagement, you would normally want to have some sort of employee council, but the extent to which you give that council power or decision making, whether it's just feeding in ideas or whether it's got any executive powers, is entirely down to you and your organisation. So they're incredibly flexible. You can do them and carry on running the business the following day precisely as you've always have done. But there are different ways of approaching it depending what you want out of it.
Yeah, but they're really quite an interesting vehicle. And again, if anybody would like a conversation with Dan, Tim, or myself actually on the subject of EOTs, we're very happy. Just pick up the phone and we'll happily have a chat about that. We had a couple of questions in the advanced questions that we don't think we could answer. One was, how long do we think the recession is going to be? And I'm afraid that's above all of our pay grades. So forgive me for not having a great answer to that one. We really need an economist back with us to help us out with that. And another question which was asking or really saying that, central London is really suffering. What do we think is going to happen about that? And again, also above our pay grade. But I suspect, my experience is that, and I'll let Dan say a few words on this at the moment, is that recessions create changes which don't go back. And I suspect this recession is going to create a lot of changes which don't reverse, and we will see a different way of working and a different geography, in all honesty, going forward. But that's just my view and not anything more technically apt. Dan, you had a couple of thoughts about that. Yeah,
I mean, speaking to businesses are all going back in different stages. Some businesses are already back. I've spoken to quite a number in sort of the IFA financial advice market where they're already back in the offices. We're opening our city office next week, and our West End office is already open, although they're not going to be at full capacity, and not everyone's going back straight away. Whereas other businesses, I've spoken to a number of banks that are opening till January, and I've spoken to some sort of listed tech firms where they're not going back till April or May. So it really is a wide range. So I think what you can count on is demand is going to, and footfall are going to be down for quite a while, but hopefully we'll start to recover. And the pace of that will probably vary depending on people's risk appetite and businesses' decisions about their employee safety, I guess. So hopefully it's going to get better, unless there's another lockdown, but I think it's going to take quite a while to get back, if it ever does, like Mandy said, to anything approaching what it was.
Okay, well, we're coming and indeed have reached the end of what the session was scheduled to finish at. Thank you very much to everybody for joining us. I'll just add my normal plea, please, 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 if you could just take 2 minutes to answer our poll about how we did and other topics you'd like us to cover. My colleague Kirsten has just posted a link to the SurveyMonkey poll in the chat, and we will also put this in our follow-up when we share the slides with you after the session. Thank you very much for taking the time out to join us, and thank you very much to our 3 speakers today, Dan, Tim and Richard. I found it very interesting, and I hope you have too, and hope to see you at next week's webinar. Thank you very much.
Thank you.
Thank you.